If you think that the housing market is slowing down, then you're missing the biggest story that's happening right now in the Inland Empire, because the October numbers just revealed a shift that almost no one is talking about. So if you're thinking about buying, selling, or investing, then you need to know what's really going on before the rest of SoCal figures it out. Now, before we dive in, just take a second to subscribe, turn on those notifications so that you never miss these updates. Real estate doesn't move slowly anymore, and the people who stay informed are the ones who win in this market. All right, let me start by saying something that recently hit me. I got a call from a family in Ontario. Stressed, overwhelmed, and honestly tired. The husband said, "John, I feel like we're always one step behind. Every time we're ready to buy, something happens. Rates spike, prices climb, or that house we're looking at just disappears." Sound familiar? Because I hear that sentence almost every week. But this October, something actually changed. And that change didn't come from the headlines, it came from data. Hard numbers, verified shifts, trends moving in a direction that we haven't seen in years. So let me break down exactly what is happening in the Inland Empire and what that means to you. So let's start with the Inland Empire, just overall, because this is the foundation. According to the October Inland Valley Association of Realtors report, the median home price came in at $623,450, down 2.6% year over year. And that's not a crash. That's not even a collapse. That is just a soft correction, exactly what a healthy market looks like after years of abnormal price surges. Now, days on the market jumped from 20 to 30, which is a 50% increase. And that tells us something important. Homes are taking longer to sell, but they are selling. New listings were down, pending sales were up, and that combination tells us sellers are listing less. Buyers are stepping in more, and balance is coming back. Now, let's talk about the cities that you actually care about: Ontario, Rancho Cucamonga, and Upland, and what their stories reveal. Now, Ontario, California. Ontario continues to be one of the strongest performers in the entire Inland Empire. Ontario's median home price is $667,359, which is up 3% year over year. And that's in a year where many cities softened. Ontario grew. There were 171 active listings with homes averaging 36 days on the market, and the price per square foot was at $405. Ontario Ranch continues to be one of the highest selling master plan communities in California. People want space, they want value, and they want newer homes, and Ontario gives them that. Rancho Cucamonga. Rancho's median price stayed at around $770, flat year over year, and that's impressive for a city with such a high demand. Rancho had 158 active listings, 34 days on the market, and at $440 per square foot. This is a stability story. Rancho remains Rancho: desirable, strong schools, clean neighborhoods, low crime, and consistent demand. Now, when priced right, homes still sell fast. Upland. Now, Upland continues its correction phase. The median price came in at around $760,000, which is down 9% year over year. Inventory is at around 78 homes, and days on market climbed to 38. Per square foot, it sits at $430 per square foot. Now, this isn't doom. Upland had a huge appreciation in 2020 to 2023, and a pullback was overdue. Now, Upland is giving buyers a rare window of opportunity. Now, let's zoom out, because the real story is happening in interest rates, jobs, inflations, bonds, and the Fed. Now, mortgage bonds have been under pressure, trading well below $101. When mortgage bonds weaken, rates rise, and vice versa. Meanwhile, the 10-year Treasury yield, the number that drives mortgage rates, has actually been bouncing between 4.08 and 4.14%. Now, these small movements matter for mortgage rates more than, well, anything else. Now, the jobs data. ADP reported 42,000 new private sector jobs in October, a slowdown, but not a shedding phase. It's meaningful because it came after 2 weak months, signaling cooling, not a collapse. Unemployment. Now, unemployment claims hit 232,000 for the week ending in October 18th, up from 219,000 in late September. Now, slowing jobs and rising unemployment plus cooling inflation equals downward pressure on interest rates. Oil is at around $60 per barrel, which reduces inflation. Lower inflation reduces bond yield pressure. Lower bond yields reduce mortgage rates. Now, then there's the stock market. The S&P 500 hit an all-time high on October 28th at 6890.89, then pulled back to 6672.41, a drop of 3.16%. Investors are taking profits, moving to safe assets. And that shift, well, that supports lower bond yields. The big moment. The September jobs report is hitting Thursday at 8:30 a.m. Eastern forecast. The forecast is actually 50,000 to 75,000 new jobs. That's a soft number, and it could trigger rate improvements. A hot number could stabilize interest rates. All of this matters because mortgage rates shape affordability more than home prices do. Now let's talk about what people are searching for right now, because psychology always leads behavior. Here's what buyers are Googling. Affordable cities in Southern California. Homes under $750,000, i.e. Ontario Ranch new construction. Inland Empire down payment assistance. Should I buy now or wait for 2026? Now here's what sellers are typing. Why isn't my home selling? Should I lower my price? How to sell my home in a shifting market? What upgrades increase value in 2025? Now, this reveals something important, and that is people are confused, overwhelmed, and actually hungry for clarity. They don't want hype. They don't want fear. They want direction. Now, let's talk about the lock-in effect. 52% of homeowners have mortgage interest rates under 4%. This has caused 1.7 million fewer home sales nationwide since 2022. This is the primary reason inventory is still tight. It's not that people don't want to move, they don't want to lose their low mortgage rate. But as rates ease, and yes, rates are slowly easing, more homeowners will finally make their move. So let's take a breath here. If you're getting value, tap the like button. It really does help more people get the truth instead of a fear-based headline. Now, here's what the data suggests for the next 12 months. Home prices in the IE expected to appreciate 2 to 5%. Inventory is actually expected to rise 10 to 15%. Sales volume is expected to jump 10% over 2024, and mortgage rates are likely going to be in the 6% to 7% range, with potential dips depending on inflation and jobs data. More motivated sellers are entering the market. More first-time buyers are stepping in as rates soften. Now, this is not 2020. This is not 2022. This is a new market. Slower, smarter, more balanced. So there's more opportunities, especially for buyers who were priced out over the last few years. Now, here is your buyer's playbook. Get pre-approved right now. Target homes selling 21 plus days. Negotiate credits and repairs. Lock in a rate if you're closing in the next 2 to 3 weeks, and float if you're 45 plus days out. Now, focus on condition, not emotion. Here is your playbook. If you're a seller, price realistically. The first 2 weeks matter the most. Staging now is important more than ever. Professional photos are an absolute must. Don't overspend on upgrades. Create move-in ready appeal. Understand your competition, not last year's prices. Now, let me close with another quick story, because this is where the market becomes real. The couple from the beginning, they're in escrow. Not because the market magically changed, but because they finally understood it. When you remove fear and actually add clarity, the right path becomes more obvious. And that's why I do these updates, so that you have clarity, confidence, and peace of mind in one of the biggest financial decisions of your life. If someone you know needs this information, share this video with them, and make sure that you subscribe and turn on those notifications so that you never miss a real update that actually helps you make smarter decisions. I'll see you in the next one. Thanks for watching.